Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all your favorite companies' messy financial paperwork. And let me tell you, if there was a messy one this time, it was all about the cash flow and some interesting loan data. BayCom Corp is back with another quarterly report, and it seems like they've been busy making some big financial moves. We're going to break down what all these numbers really mean for the company and its shareholders. Stick around because this is where the real story is. Before we dive in, if you appreciate getting straight insights from corporate documents without the fluff, make sure you hit that subscribe button. And hey, if you want to chat more about these filings and get ahead of the curve, join our Discord community linked in the description below. Alright, let's get into it. BayCom Corp, the parent company of United Business Bank. As of the 30th of September 2025, they had total assets of about $2.6 billion. That is a slight dip from the end of last year, mainly because they used a good chunk of cash to pay off some debt. Their actual cash in hand and easily accessible funds, which we call cash and cash equivalents, went down by about 37%. They used this cash for a couple of big things. A major one was paying off some subordinated notes, like a type of long-term debt, a pretty significant amount of about $63.7 million. They also used it for loan growth and to cover some money leaving their deposit accounts. Now let's look at their investments. Their investment securities available for sale, which are basically investments they can sell if needed, went down a little bit by around 3%. This is mostly due to normal maturities and repayments, with some new purchases balancing it out. They didn't sell any of these securities in the last few months. Interestingly, they have a lot of these investments that have lost some value on paper, meaning their market price is lower than what they paid for them. But the company believes they will get all their money back, mainly because the value drop is due to interest rate changes, not because the borrowers are in trouble. The core of their business as a bank is loans. Their total loans grew by about 4.6%, reaching nearly $2 billion. This growth comes from new loans they've made and loans they've bought from other places, though they also had some loan repayments and a few sales. A big part of their business is commercial real estate loans, making up over 85% of their total loan portfolio. They are quite concentrated in this area, which can be a risk if the real estate market takes a downturn. Now, for some concerning signs, their non-performing loans, which are loans where borrowers are having trouble paying, have gone up. At the end of September 2025, these loans were about 0.68% of their total loans. This is higher than the previous year. Most of this increase came from commercial real estate loans. This is definitely something to watch. To cover potential loan losses, they have an allowance for credit losses. This allowance grew to over 1% of their total loans. This increase partly reflects the growth in their loan portfolio and also new economic forecasts that suggest a tougher economic climate ahead. They saw more loan defaults and a weaker outlook for the economy, which naturally makes them set aside more money for bad loans. Let's talk about where they get their money from. Deposits are their main funding source. Total deposits actually decreased slightly. They saw a drop in non-interest bearing deposits, meaning accounts that don't earn interest, but an increase in interest bearing accounts. This signals that customers are moving their money to accounts that offer better interest rates, probably due to the current economic environment. As for other ways they fund themselves, like borrowing money, they seem to be in a good spot. They had pretty substantial borrowing capacity with the Federal Home Loan Bank and the Federal Reserve, but fortunately they had no outstanding borrowings from these sources. This means they are not reliant on these costly short-term funds and have a strong financial foundation. They also have lines of credit with correspondent banks, but again, no outstanding balances. Their shareholders' equity, which is basically what the owners have invested in the company plus retained earnings, went up. This is good news. The increase was mainly from the net income they earned and some positive changes in the value of their investments. However, this was offset by them buying back some of their own stock and paying out dividends to shareholders. Looking at their profit, net income for the 3 months ended September 2025 was lower than the same period last year. This was mainly because they had to set aside more money for potential loan losses, and because their non-interest income, which includes things like fees and gains from investments, took a hit. For the 9-month period, net income also saw a slight decrease for similar reasons. Their interest income, the money they make from loans and investments, did go up. This is a positive sign, and it shows they are earning more on their loans thanks to higher interest rates and more loans on their books. This is pretty much the bread and butter of a bank's income, but their interest expense, the money they pay out on deposits and other borrowings, also increased. This means it costs them more to hold on to customer deposits, likely due to competitive pressures and higher market rates. This brings us to their net interest margin, which is how much profit they make from the difference between what they earn on loans and what they pay for deposits. For the 3-month period, it slightly decreased, mainly because the costs of borrowing money went up faster than the earnings on their assets. However, for the 9-month period, their net interest margin actually improved a bit. This suggests they are managing their interest rate risks pretty well overall. Their non-interest income, which is income not from interest like fees or investment gains, went down significantly. A big reason for this was a drop in gains from their equity investments. This isn't necessarily a bad thing, as these gains can be very volatile and depend on market ups and downs. Employee costs like salaries and benefits went up. This is pretty common for growing companies or in periods of inflation. Total assets for BayCom Corporation itself, the parent company, decreased slightly. Most of their assets are in their investment in United Business Bank. They had some cash on hand to cover their own expenses and dividends. Now, let's talk about their financial health from a regulator's perspective. The bank, their subsidiary, is considered well capitalized by the Federal Reserve. This is a really good sign. It means they have more than enough capital to absorb unexpected losses and meet their obligations. Their capital ratios are well above the minimum requirements and comfortably above the buffer needed to avoid restrictions on things like dividends and share buybacks. So what is the overall story here? BayCom Corp is navigating a challenging economic environment. On one hand, their loan portfolio is growing and they are earning more interest on their new loans and investments, which is great. They also maintain strong capital levels, which makes them financially resilient. However, the increase in non-performing loans, particularly in commercial real estate, is a red flag. While they have increased their allowance for loan losses, which is a responsible move, this trend needs to be closely monitored. The slight decrease in their net interest margin for some periods also shows the pressure on their profitability from rising funding costs. Their strategy of acquiring other banks and focusing on commercial lending has helped them grow, but it also concentrates their risk in specific sectors like commercial real estate. The company needs to be cautious about managing these concentrations, especially with the current economic uncertainties. In conclusion, BayCom Corp appears to be a financially stable bank with strong capital, but they are facing increasing credit risks in their loan portfolio. Their ability to manage these risks and adapt to changing economic conditions will be key to their future success. It is a mixed bag, but the strong capital position provides a good cushion. So what is your take on these numbers and what they signal for the company's future? Do you think their focus on commercial real estate is too risky? Let me know your thoughts in the comments below. If this breakdown was valuable, hitting that like button really helps us out. And subscribe for more deep dives into corporate finance. And remember to check out the Discord link in the description if you want to join the conversation. Thanks for watching. See you next time.